A small number of institutional asset managers now hold enormous stakes across nearly every major publicly traded corporation in the world. At the top of this pyramid sit three firms, BlackRock, Vanguard, and State Street, which together manage more than $20 trillion in assets. They are the largest shareholders in most Fortune 500 companies, in the biggest banks, in pharmaceutical giants, in defense contractors, in media conglomerates, and in technology platforms. Even more striking, they own significant stakes in each other, creating a circular ownership structure that defies traditional ideas about competition and independence. This is not a conspiracy. It is the logical outcome of decades of financialization, in which retirement savings, pension funds, and passive investment vehicles have channeled ever larger pools of capital into the hands of a few index fund managers. The rise of these megafirms did not happen by accident. It was enabled by a structural shift in how ordinary people save and invest. A generation ago, many Americans relied on defined benefit pensions, in which employers promised fixed retirement income based on years of service. Those pensions were managed by in-house teams or hired advisors, and they invested directly in stocks and bonds. Over time, that model gave way to defined contribution plans, especially 401k accounts, which placed the responsibility for saving and investment onto individuals. Those individuals, in turn, were offered a menu of mutual funds and index funds. The funds that grew fastest were those that charged the lowest fees and promised to match the performance of broad market indexes. Index funds do not try to pick winners. They simply buy every stock in an index, weighted by market capitalization. The bigger the company, the more shares the fund buys. BlackRock, Vanguard, and State Street became dominant because they mastered this model. BlackRock, founded in 1988, built its reputation on risk management technology and then expanded aggressively into index and exchange-traded funds through its iShares platform. Vanguard, established in the 1970s by John Bogle, pioneered low-cost index investing and structured itself as a client-owned cooperative, a design that made further expansion natural. State Street, older than both, became a leader in institutional index products and exchange-traded funds. All three firms share a key characteristic: they manage money on behalf of others. They are not proprietors investing their own capital, but fiduciaries holding assets that belong to pension funds, university endowments, sovereign wealth funds, insurance companies, and millions of individual retirement savers. The scale of assets under management gives these firms unparalleled influence. When BlackRock, Vanguard, and State Street collectively hold 5, 10, or 15% of every major corporation, they become the single most important block of shareholders at annual meetings. They vote on executive pay, board elections, mergers and acquisitions, and shareholder proposals on environmental, social, and governance issues. Their analysts meet regularly with corporate management. Their stewardship teams publish voting guidelines that companies study carefully. While each firm insists it acts in the interest of its underlying investors and not as a unified cartel, the concentration of voting power in three sets of hands is unprecedented in the history of capitalism. Critics note that even if the three firms sometimes vote differently on marginal issues, their shared interest in broad market stability and fee income aligns their incentives in ways that can blunt competitive pressures. The circular ownership problem is especially striking. BlackRock is among the largest shareholders in Vanguard funds that invest in index products, and Vanguard is among the largest shareholders in BlackRock's publicly traded parent. State Street is a major holder in both, and both are major holders in State Street. Each firm holds pieces of the others through the index funds and exchange-traded funds they manage. On paper, these are passive holdings. The funds buy shares because the companies are in the index, not because of any strategic intent. In practice, this creates a web in which the three giants are partially owned by each other, reducing the likelihood that any of them will aggressively challenge the other's business models or fee structures. The loop reinforces itself. Investors seeking low-cost index exposure flow to these three because of their scale and liquidity, which makes them bigger, which makes them even more attractive to the next wave of capital. This concentration extends across industries in ways that raise questions about competition. In the airline industry, BlackRock, Vanguard, and State Street are major shareholders in Delta, United, American, and Southwest. In banking, they hold large stakes in JP Morgan, Bank of America, Citigroup, and Wells Fargo. In pharmaceuticals, they are top investors in Pfizer, Johnson & Johnson, Merck, and AbbVie. In technology, they own significant pieces of Apple, Microsoft, Alphabet, Amazon, and Meta. The pattern repeats in oil and gas, retail, telecommunications, and defense. Traditional antitrust analysis focuses on market share within a single industry and asks whether firms with pricing power collude or merge. The new reality is that the same set of institutional owners sits at the table in every boardroom, holding stakes in direct competitors and exerting influence through private meetings, voting, and the ever-present threat of divestment. One argument in favor of this structure is that index funds benefit ordinary investors by offering diversification, low fees, and consistent returns. A middle-class worker contributing to a 401k can own a slice of the entire US or global economy for a fraction of the cost that active management once demanded. Proponents note that BlackRock, Vanguard, and State Street compete with each other on fees and service, even if they invest in similar portfolios. They also argue that passive investing imposes discipline on corporate managers. If a company underperforms, its stock price falls, and the index funds automatically reduce exposure. This is portrayed as a meritocratic feedback mechanism, rewarding efficiency and punishing waste without the need for activist intervention. Critics counter that the concentration of ownership undermines the very competition that is supposed to discipline firms. If the largest shareholders of Airline A also own Airline B, they may prefer that both airlines keep prices high and capacity tight, rather than engaging in a price war that would hurt profits across the sector. The same logic applies to banks, pharmaceutical companies, and technology platforms. Academic studies have found correlations between common ownership by large institutional investors and reduced competition, higher prices, and lower wages in concentrated industries. The mechanism is subtle. There is no need for explicit coordination or collusion if the incentive structure naturally aligns toward industry-wide profitability rather than individual firm dominance. Another concern is the exercise of voting power. BlackRock, Vanguard, and State Street cast millions of proxy votes every year on behalf of their fund's investors. In theory, they are supposed to vote in the best interest of those investors. In practice, the sheer volume of votes means decisions are often guided by broad policies and algorithms with limited engagement on company-specific nuances. Stewardship teams at these firms are small relative to the number of companies they oversee. They rely on guidelines, third-party proxy advisors, and engagement priorities that may reflect the preferences of the asset manager's leadership rather than the diverse views of underlying investors. This creates a principal-agent problem. Millions of individual savers have delegated their ownership rights to institutions that exercise those rights in ways the savers may not fully understand or agree with. The regulatory environment has struggled to keep pace. Antitrust law in the United States was written in an era when ownership and control were more tightly linked and when cross-ownership of competitors was rare. Modern index funds fragment ownership in ways that make it difficult to assign responsibility for anti-competitive outcomes. Meanwhile, securities regulators focus on disclosure, transparency, and preventing fraud, not on the systemic effects of concentrated passive ownership. Proposals to address the issue range from capping the percentage of an industry that a single fund family can own, to requiring funds to pass voting rights directly to individual investors, to breaking up the largest asset managers. Each approach faces practical and political hurdles, and none has gained enough traction to reshape the status quo. The circular ownership among BlackRock, Vanguard, and State Street adds an additional wrinkle. Because they hold each other's shares, any regulatory move that weakens one of them could, in theory, harm the portfolios of the others. This interdependence may reduce the incentive for any of the three to support reforms that would fragment the industry. It also complicates efforts to understand who truly controls these firms. Vanguard is structured as a mutual company owned by its funds, which are in turn owned by investors. BlackRock is a publicly traded corporation with dispersed shareholders, including Vanguard and State Street funds. State Street is similarly public, with significant holdings by BlackRock and Vanguard. The result is a loop in which ownership chains fold back on themselves, creating an architecture that is difficult to map and even harder to govern. For most people, these dynamics are invisible. When a worker checks their retirement account balance, they see a number and perhaps a list of fund names. They do not see the voting records, the engagement meetings, or the cross-ownership structures. They do not realize that a handful of institutions are simultaneously their largest shareholders and each other's largest shareholders. The system functions smoothly as long as markets rise and fees remain low, but it has created a concentration of financial power that is historically unusual and that carries risks which are only beginning to be understood. If decisions made in a few boardrooms in New York and Boston determine the strategic direction of most major corporations, the boundaries between ownership, competition, and governance blur in ways that challenge foundational assumptions about how capitalism is supposed to work. The 13 banks, or more precisely the 3 megafirms and the network of institutions around them, do not own everything in a literal sense. But they hold enough equity and wield enough voting power that the distinction may be less meaningful than it once was. The influence of these 3 firms extends beyond corporate boardrooms into the political and regulatory arenas themselves. BlackRock in particular has cultivated deep ties with governments and central banks around the world. Its executives cycle through positions in the U.S. Treasury, the Federal Reserve, and international financial institutions. When the Federal Reserve needed technical expertise to manage emergency asset purchases during the financial crisis, and again during the pandemic, it contracted BlackRock to administer the programs. This gave a private asset manager operational control over public policy tools, blurring the line between state and market in ways that attracted little public scrutiny at the time, but that set a striking precedent. Vanguard and State Street, while less visible in such arrangements, maintain their own networks of influence through industry associations, lobbying, and advisory roles that shape the regulatory landscape in which they operate. The fee structure that sustains these firms also deserves attention. Index funds charge low annual fees, often just a few basis points, which seems modest. But when applied to trillions of dollars in assets, those basis points translate into billions of dollars in revenue each year. BlackRock's annual revenue exceeds $10 billion. Vanguard and State Street generate comparable sums. These revenues fund the infrastructure, technology, and personnel that enable the firms to manage vast portfolios and engage with thousands of companies. Yet because the fees are deducted automatically from investor accounts, and because they are marketed as minimal compared to active management, most investors never feel the cost directly. The result is a silent transfer of wealth from the broad base of savers to a narrow set of institutional intermediaries, a transfer that is entirely legal and rarely questioned. There is also the question of systemic risk. The traditional concern about too-big-to-fail institutions has focused on banks whose collapse could trigger cascading failures in the credit system. Asset managers present a different kind of risk. They do not lend money or take deposits, so they are less vulnerable to classic bank runs. But their size and interconnectedness mean that operational failures, cybersecurity breaches, or sudden mass redemptions could destabilize markets. If a technical glitch or loss of confidence caused a wave of selling across BlackRock's iShares platform, the liquidity and pricing of entire markets could be disrupted. Regulators have designated some large asset managers as systemically important, subjecting them to additional oversight, but the framework remains underdeveloped compared to the regulatory architecture around banks. Another dimension is the homogenization of investment strategies. When trillions of dollars flow into index funds that mechanically buy shares based on market capitalization, price signals can become distorted. Companies that are already large attract more capital simply because they are large, not necessarily because their fundamentals warrant it. This can create momentum-driven bubbles and reduce the efficiency of capital allocation. Smaller companies, even if innovative and well-managed, may struggle to attract investment because they do not meet the liquidity and size thresholds that index funds require. The result is a two-tier market, a small number of mega-cap stocks that benefit from relentless index-driven inflows, and a broader universe of firms that face relative neglect. The international dimension adds further complexity. BlackRock, Vanguard, and State Street are not just American phenomena. They manage assets globally and hold significant stakes in companies across Europe, Asia, and emerging markets. This gives them leverage over corporate governance standards worldwide. When these firms push for environmental, social, and governance reforms, they can shift practices in multiple jurisdictions simultaneously. Critics in some countries view this as financial imperialism, a situation in which Wall Street institutions impose values and priorities that may not align with local preferences or development needs. Supporters argue that global coordination on issues like climate risk and board diversity is necessary precisely because capital markets are interconnected and because no single country can address these challenges alone. Finally, there is the problem of accountability and voice. Index fund investors technically own shares, but in practice, they have outsourced nearly all ownership decisions to asset managers. If an individual disagrees with how BlackRock or Vanguard votes on a particular issue, say executive compensation at a tech company or a merger in the pharmaceutical sector, there is no mechanism to express that dissent other than selling the fund and moving to another manager, who may vote the same way. Mutual funds and exchange-traded funds are built for liquidity and simplicity, not for granular investor governance. The efficiency that makes them attractive also strips away the participatory elements of ownership. Shareholders become passive recipients of returns, while actual power rests with the professional class that manages their money. This transformation completes a decades-long process in which capitalism evolved from a system of owner-entrepreneurs to a system of diffuse savers and concentrated intermediaries, with the intermediaries wielding most of the authority and reaping a steady stream of fees for their role as gatekeepers.